Your bank deposit is literally a rigged commercial loan.
When you put money in the bank as a bank deposit, you are a unsecured creditor, and you technically and legally have given a loan to the bank. So that is the key message of today's show, because I think a lot of Australians don't think in those terms.
No, John, the urban myth is that you are effectively giving your money to the bank for them to look after on your behalf, right? And they'll pay you a bit of interest. And any time you want the money back, you can just go knock on the door and say, give me my money back. That's
Yes.
the urban myth, right? The reality is completely different. If a bank completely collapses and it needs to be effectively unwound, right, then there's a hierarchy of distribution, right? And right at the bottom are shareholders, so they probably won't get much back. But at the top, guess who comes first? The taxman, the liquidators, so they get paid out first. Then secured creditors, so anybody who's got security with the bank gets paid out, right? Then you go into the unsecured level, and what this says, and it's same with the Banking Act earlier on, is that the depositors rank above other unsecured creditors. So you're way down the list, but you're not right at the bottom.
Yes, but yes. So you're at the top of the list of unsecured creditors,
Yep.
but you are a unsecured creditor.
Absolutely.
Yes.
Yep.
Now, so now that we've established that when you put your money in a bank, you have technically given the bank a loan.
Yep.
Now, the other part of the title of the show is that you've given a rigged loan. Now, the key point on this one, Martin, is why is the loan rigged? Is because typically when you give someone a loan, you as the lender dictate the terms of how you lend. And obviously, when we go to the bank to get a mortgage or a car finance or a credit card, etc., the banks dictate the conditions of how we will borrow the money from the bank, because they're giving us the money.
Yep.
But when we, as the depositor, put our money into the bank, well, the borrower, as in the bank, they dictate the terms and conditions of how this loan arrangement will actually come about, and we as the lender just have to accept that on face value. So now, and obviously that's quite critical when we think about the whole topic of bail-in, when we think about in terms of the cash ban and the freedom from banks. Well, when we think about the $10,000 cash transaction ban, it's in effect the freedom not to loan a bank money because we are unsecured creditors.
My argument is that, there are some risks attached to deposits, but, you've got to weigh those risks up against the other ones. And I've, at the moment, weighed them up, that I don't think the risks are as extreme as you see them, but I do understand the limitations of deposits, and I do understand that it is a loan to the bank. What we can say, John, is read your terms and conditions, right, if you're going to put money in the bank, and understand that there are some risks attached. So deposits are not risk-free, right? And then it's a trade-off between deposits versus other asset classes.
That's
right. The bottom line is, wherever you look, there are risks.
Mm-hmm.
And that's probably the most important takeout from here.